In the vast and complex world of finance, the journey to wealth building can sometimes feel like a daunting expedition. The good news is that you don't need to be a Wall Street expert or possess a crystal ball to make informed and impactful choices with your money. Today, we'll demystify two popular investment vehicles, index funds and exchange-traded funds, ETFs. These financial tools can serve as the compass to guide you towards a more secure and prosperous future. But before we delve in, remember to hit that subscribe button and give this video a thumbs up. Also, make sure to watch till the end because the final tip has the potential to significantly enhance your financial decision. Now, let's begin. Content structure. Index funds, akin to ETFs, are designed to mirror the performance of specific market indices like the S&P 500. What sets them apart is their structure. Index funds are typically managed by a fund company such as Vanguard or Fidelity. When investing in index funds, you buy and sell shares at the net asset value at the close of the trading day. This means that regardless of when you place your order during the day, the price you receive will be based on the NAV calculated at the market's close. On the other hand, ETFs, while also tracking indices, are traded on stock exchanges like Apple or Microsoft shares. This feature provides greater flexibility, allowing you to buy and sell them at market prices throughout the trading day. This real-time trading capability sets ETFs apart and can be particularly advantageous when you want to react quickly to market movements or adjust your investment strategy. Moreover, ETFs often boast lower expense ratios compared to index funds due to their passive management. This translates to reduced costs over time, making them appealing to cost-conscious investors. For example, the SPDR S&P 500 ETF closely mirrors the S&P 500 index and is traded like any other stock, making it a prime example of the ETF structure. Cost. Costs play a pivotal role in the world of investing, significantly influencing the returns you can expect over time. When comparing index funds and ETFs, the difference in costs is a crucial factor that should not be overlooked, particularly for beginners venturing into the world of finance. Index funds typically come with slightly higher expense ratios. This is due to the active management involved in their structure. Here's why. In the realm of index funds, professional portfolio managers actively buy and sell stocks to try and outperform the market or their benchmark index. This active management incurs costs, which are passed on to the investors. While these costs might not seem substantial in the short term, they can eat away at your long-term gains. On the flip side, ETFs are more passively managed. They track a specific market index and aim to replicate its performance. This passive approach generally results in lower costs for investors. ETFs often have lower expense ratios because they do not involve the same level of hands-on management as index funds. To illustrate, imagine you are investing $10,000 in both an S&P 500 index fund and an S&P 500 ETF. The slightly higher expense ratio of the index fund could mean that over the years, you end up with less money in your pocket compared to the ETF. For beginners looking to grow their wealth steadily over time, minimizing expenses can be a critical part of their investment strategy. Liquidity. Liquidity is a critical aspect to consider when choosing between index funds and ETFs, and it can significantly impact your investment experience. To put it simply, liquidity refers to how easily you can buy or sell an investment. In this context, we'll explore how index funds and ETFs differ in terms of liquidity and why it matters for beginners. Index funds, often found in the mutual fund realm, have a distinct liquidity characteristic. When you invest in index funds, you can buy or sell shares known as mutual fund units at the end of the trading day at a price known as the net asset value. This means that your transactions are processed once a day and you'll receive the price determined after the market closes. It's akin to ordering a meal at a restaurant, but you have to wait until the chef finishes cooking before you can enjoy it. On the other hand, ETFs provide a much more flexible liquidity structure. These funds trade on stock exchanges just like individual stocks, enabling you to buy or sell them at any point during the trading day at market prices. This is akin to going to a supermarket and picking up items off the shelves whenever you want. For instance, if you hold an index fund and you decide you want to sell your shares, you'll have to wait until the market closes to get the price for your transaction. This lack of intraday trading can be limiting if you need to respond quickly to market events or simply prefer more control over the timing of your trades. ETFs, conversely, let you react promptly to market developments, adjusting your portfolio as you see fit throughout the day. This liquidity difference between index funds and ETFs can be vital for beginners. ETFs offer a higher degree of control and flexibility, allowing you to adapt to market changes or make decisions based on your circumstances, while index funds require a more patient approach as you can only execute your orders at the day's close. Understanding this distinction and how it aligns with your investment strategy is crucial for a successful investment journey. Minimum investment. Investing in index funds and ETFs can be an excellent way for beginners to start building their investment portfolios. However, another significant factor that can influence the choice between the two is the minimum investment requirement. Index funds, while providing the benefit of diversification by tracking specific market indices, often come with minimum investment requirements. These minimums can vary significantly depending on the fund and the fund company, but they can sometimes be substantial. For example, a particular index fund might have a minimum investment requirement of $3,000 or even more. For beginners with limited capital, this can be a significant barrier to entry as they may struggle to meet the initial investment threshold. On the other hand, ETFs typically do not have such minimum investment requirements. This is one of the aspects that make ETFs more accessible and appealing to a wider range of investors, especially those who are just starting and may not have a substantial amount of money to invest. You can buy as few or as many ETF shares as you like, and this flexibility is advantageous for individuals who want to start investing with smaller amounts of capital. For instance, if you have $500 to invest, you can allocate that amount directly to an ETF without any restrictions or limitations. This flexibility in investment amount makes ETFs a more inclusive option, allowing beginners with limited capital to begin their investment journey without facing the barriers posed by minimum investment requirements that are often associated with index funds. Tax efficiency. Tax efficiency is a critical aspect of investment that often goes unnoticed but can significantly impact your returns over time. It's particularly relevant for beginners who want to make the most of their investments while minimizing tax liabilities. Index funds and ETFs, while both providing diversified exposure to various assets, differ in their tax efficiency. Index funds, being mutual funds, are structured in a way that can make them less tax efficient. When other investors in the fund redeem their shares, it can trigger capital gains taxes for all shareholders. This means that you may be on the hook for taxes on gains generated by other investors even if you haven't sold any of your shares. For instance, if you are invested in an index fund and a large number of other investors decide to cash out their holdings, the fund may need to sell underlying assets to meet those redemption requests. This selling activity could generate capital gains, which in turn get passed on to the remaining investors, potentially leading to tax consequences. On the other hand, ETFs are generally more tax efficient due to their unique creation and redemption process. When new shares of an ETF are created or existing shares are redeemed, it often happens in kind. This means that securities are exchanged directly between the ETF and authorized participants, usually large institutional investors, without triggering a taxable event. As a result, ETFs can minimize capital gains distributions and help investors avoid unexpected tax bills caused by the actions of other shareholders. To illustrate, imagine you own shares in an ETF that tracks a particular index, and some investors decide to redeem their ETF shares. Instead of the ETF having to sell its underlying assets and generate capital gains, the authorized participants can transfer a basket of securities to the ETF. This process prevents the realization of capital gains, preserving the tax efficiency of the investment for all remaining shareholders. Trading flexibility. Trading flexibility is a crucial aspect to consider when comparing index funds and ETFs for investment, and it can significantly impact your ability to respond to market dynamics. In this regard, ETFs stand out as the more versatile option. Index funds, which are mutual funds, are only traded at the end of the trading day. This means that when you place an order to buy or sell shares of an index fund, the trade is executed at the fund's net asset value price calculated at the close of the trading day. This rigidity can pose challenges for investors who want to make quick decisions in response to market news or events. On the other hand, ETFs, or exchange-traded funds, offer intraday trading. They trade on stock exchanges just like individual stocks, enabling investors to buy or sell them at any point during the trading day. This level of flexibility allows you to react swiftly to market fluctuations. For example, if you are following a news release that you believe will impact a specific sector or index, you can buy or sell an ETF tracking that sector immediately after the news is announced. The speed can be a significant advantage, particularly for active traders and those who want to implement more sophisticated trading strategies. Although index funds and ETFs are excellent options for beginners, ETFs are often favored for their lower costs, tax efficiency, and intraday trading flexibility. However, the choice between the two ultimately depends on your specific investment goals, preferences, and the brokerage platform you use. Let us know in the comments which option you think provides better diversification for novice investors. I'll see you in our next video.